Hey, everybody, welcome. Episode 197, I believe. Going to try and keep that intro song short so we're not flagged by YouTube. I don't know why we had copyright violations a couple of episodes ago, but we'll try to figure that out. Hey, if you're in Canada like me, happy Victoria Day. It's a long weekend here. This is when we celebrate, well, whatever. It's May long weekend in the U.S. Next weekend, I believe it's Columbus Day. And we get Victoria Day for Queen Victoria, born sometime in the mid to late 1800s, I believe. And so I wasn't going to get a show out for you today. But we're releasing this Tuesday mornings, by the way. Normally, we release the Winning Momentum podcast at 5 a.m. Eastern on Tuesday mornings. And normally I'd have some shows in the library for you, ready to go. So when we have long weekends, I could just push release. But not the case right now. I've been doing a bunch of speaking and not getting podcast work done. So, for example, I did a webinar for Gowling WLG last week. I got to see if I can get that camera a little bit straighter. Where we spoke, it turned out to be about 180 to 200 bankers across Canada. Me and David Cohen, a senior national, internationally recognized lawyer with Gowling WLG, and as I said, it was about 180 plus bankers across the country. But what was interesting is it was 2 hours, a 2-hour discussion between the two of us, and we didn't lose any audience. Like, the numbers just stayed strong for the entire 2 hours. So it was pretty engaging, I guess. We got a great review. And then after that, I've been preparing for a Vegas trip where I'm on stage this week. In fact, so I leave early in the morning. I'm on stage this week. And if I have time today, which I'm sure I will, I'm going to give you, I'm going to walk you through part of my speech on that, which is 3 actions to immediately improve your business. And a couple of shows ago, I did the rough draft of that. I took what was supposed to be a 20-minute speech and talked out loud about it to you for about an hour. And I actually got some interesting feedback on that. Anyways, it's been distilled now. And as of Saturday, so I'm recording this on Monday. As of Saturday, I got it to 20 minutes and 18 seconds, which is, I need to be 20 minutes. And this morning I did it once and it was 21 minutes. So I'm right in the ballpark. And people were doubting that I was going to get that hour of content distilled down, but I did. Anyways, as I said, in Canada, happy Victoria Day yesterday, since this is released on Tuesday. And I just wanted to get out to you and not miss a week for those of you counting on this show and enjoying touching base with me. So I'm going to cover a couple of things today. We had a lot of listener questions come in on different platforms of mine. And one of them was about partners. I don't recall what the exact nature of the question was, but the essence was, how do you get rid of a bad partner? How do you get rid of a bad partner? Now, when people use the word partner in business, most of the time, it's not really a partner, it's a shareholder, right? So the two of you have started a business together or bought a business together. You own shares, I own shares. We could be 50-50, we could be 99.1%, but we have shares. And people refer to that as a partner. And the reason I'm making that distinction is the legal side and the consequences of that are different in a partnership agreement versus a corporation. I'm going to assume this is a corporation. There's a lot about this question that I cannot answer because I don't have the context in enough detail, okay? But let's just walk through this in general. And on the predecessor podcast, the predecessor to the Winning Momentum podcast, which was Martinis with Scott, you can go on the YouTube and surf back and check out old episodes. And you're going to find that we've covered this a couple of times. The interview with Rob Fraser comes to mind, and I'll be recording another show with him shortly, I believe. But if you could just look up Rob Fraser in the history of Endure, which I believe is now branded Outweigh. So we'll learn more about that in the upcoming weeks. But Rob's early days as an entrepreneur, as starting a company, he had a partner that was the money partner, as I recall, and he was the entrepreneur, the man with the vision, so to speak, and was driving the business forward. And they had a falling out. I won't get into the details. You can go back and listen to Rob's words on that, and the hell that he had to go through to get rid of that partner, and the money that he had to spend to buy this fellow out, the money he had to spend on lawyers because they didn't have a shareholders agreement. So the first comment I would have about quote unquote partners, air quote partners, meaning bringing in a shareholder, or you want to partner with your friend or family member or acquaintance or professional relation. You want to, hey, let's start a business. Let's start a business together. And the first thing you need to ask yourself is why? Why am I starting this business with another person? You know, business is hard enough. I talk on the Winning Momentum podcast about the statistics, the chances. What are the odds that you're going to survive? And the truth of the matter is that 90% of all new businesses fail, in the sense that they never, ever, ever, ever pay their founder a living wage. They just never pay a living wage to their founder. And then of the 10% that do succeed, in the sense that you can take a paycheck, 80% of those never create transferable wealth, intergenerational wealth, sustainable wealth. So in other words, you can't sell the business and take a big check and retire and leave your kids an inheritance off of that. So the intergenerational sustainable wealth is really 2% of new businesses. The odds are so stacked against you in starting up a new business. Why would you complicate that if you didn't have to? Why would you complicate that with a partner who may be totally aligned with your objectives right now? It's like being married, right? You're in love, your objectives are aligned, you have the same goals and values. Well, what are the odds of that being true 5 years from now or 7 years from now, even a shorter time frame? What are the odds of everything just working out exactly like you thought, doing the hard work and taking all that risk, the trials and tribulations and the failure that you have to go through to ultimately succeed? What are the chances that you will have brought in the right person to do that? And so the first thing that you have to ask yourself is why. I remember years ago, I had a friend, a great friend, still one of my best friends out of university, who left I have to figure out how to tell you this story without giving away too many details and confidential information, or just information I'd rather keep private for him. But he left a cushy, excellent government job where he was a world-leading expert in a really obscure area of finance. And he wanted to start his own advisory brokerage firm, let's put it that way. And we talked about it. You know, he called me for advice, and we're about the same age. This was a long time ago now. He called me for advice, and he was going to bring his boss as a partner into this deal. So the two of them, I mean, you could just picture it. The two of them are out having drinks. They come up with a great idea. Hey, we should do this. Yeah, we should do that. We can make more money. We can steal these customers and, you know, get commissions on those. And that's our initial business plan. And you bring this partner in. And so off you go. And the entire reason for having a partner is friendship and fear and the adventure, sharing your adventure with somebody. Let's put it that way. So it's sharing your adventure, conquering fears together, not taking that step alone. Well, that's not a good enough reason to have a partnership. And you just see that all the time. And I don't have off the top of my head the statistics of failing partnerships, but I'm sure they correlate very strongly with failing businesses, whether you're in a partnership or not. And so I'm not saying never have a partnership. Obviously, you ought to. But when you do, you need two things. And number one is everybody who's a partner in this new business needs to have a role, and they need to have skill sets and and they need to bring something to the table that is unique, that is different from the other quote unquote partners. Okay. It can't just be because of friends and setting out on this adventure together. I don't think that's good enough. I think that really kills the odds of this thing succeeding. Whereas if you look at any long-term partnerships, they're very often people that think alike, but they have very different skill sets and they complement each other. All right. Same as any relationship between two human beings. So what do you do? The specific question was not whether to take on a partner. I just wanted to say my bit on whether partnership was a good thing or not. But what do you do if you have a partner and that partner is turned evil, or they're not useful, or you just in general don't want to be a partner anymore? What do you do about this? And the answer is, I said you need to do two things to bring on a partner. And one is be damn sure you have the right partner with the real reasons, someone that's complementary in skill set and values to you. And the second thing you need is a shareholders agreement. And so the answer to the question is, if you do not have a shareholders agreement, you're kind of screwed. Like, there's no way to force somebody to sell their shares or to force them, for you to buy the shares, okay, in the absence of a shareholders agreement. Now, I'm not trying to give legal advice. I don't know what jurisdiction everybody's in that's listening to this. Share transfers and corporate law are sort of dictated by the corporate legislation of whatever the jurisdiction is, where the business is and where it's incorporated very often. So things change. But in general, it's almost impossible to force somebody to sell the shares, to give up the shares, to get rid of the partner in the absence of a shareholders agreement. And, so you're stuck with really tricky corporate transactions, M&A type transactions, to try and drive somebody out, which is, if it's just two partners, are not going to work anyways. If you have multiple partners, it might work. And again, it depends on your jurisdiction and what law you're operating under. But, that's really a thin opportunity. And so you don't have much of anything other than litigation. And again, litigation isn't going to force somebody to sell their shares. That doesn't make any sense. And then you litigate over something else, and you threaten and you try to force a settlement at the end of the day. Or you try to convince this rogue partner, the person that you're not happy with, to sell entirely to a third party, right? We'll just all sell this business and just like get away from each other is another option. But it's all, at the end of the day, it's all just a settlement. It's all just agreement between the partners, because there's nothing contractually or in law which is going to force a settlement for the benefit of everybody. We did on the Martinis with Scott channel, I talked to you about Rob Fraser. We did a series on a woman who I was trying to, I did help in a situation very similar. We codenamed her Mary, and we walked through pretty much the exact circumstance where she was in at the time. I forget when this was, beginning of the pandemic, so maybe 2 years ago plus now. And she was in a business with her partner. They had no shareholders agreement, and what we were able to do in that situation was really understand the soft spots of her partner and to focus on other parts of the balance sheet. So what do I mean by that? Well, in this particular case, the partner of Mary's didn't have any money into this thing as a loan. So in other words, two women, and they start up a business and say, okay, you're 50, I'm 50. Now we're 50-50 in a business. Oh, wait a minute. The business needs some money. And Mary is the one that lent the money into the business. So the business owed her money. And we were able to use that debt as leverage, because we could put the company into bankruptcy. We could, demand repayment of that debt and start to apply a lot of leverage in that negotiation. But at the end, what I'm trying to tell you is it's a negotiation. If you don't have a shareholders agreement, and if you don't have a debt instrument, a secure debt instrument that's going to trump equity, whether or not there's a shareholders agreement, then you're you're just left with trying to leverage and negotiate and persuade your partner to get them out of the deal. And we were very successful in that Mary situation. I won't go through the details. In fact, I don't even remember the details, but you can look that up on the Martinis with Scott channel, which is, it's the Winning Momentum podcast. You can look that up on YouTube, but a lot of the prior episodes were branded Martinis with Scott, and you'll be able to find those on there. I've talked about a shareholders agreement. What is a shareholders agreement? We're just going to cover that briefly here, since I didn't make any notes for myself on this, but a shareholders agreement is a contract. It's a contract. And what it says is, hey, here's our shareholders. So if you have 50-50 shareholders, Miss A and Miss B, well, A has 50 shares, B has 50 shares, and it's a contract between the two of them. And there would be 3 signing parties. There would be A would sign this contract, B would sign the contract, and the company itself would sign the contract because it agrees to be governed by the shareholders agreement. And it really doesn't matter how many shareholders you have in a private company. They can all be subject to a unanimous shareholders agreement. In other words, everybody who gets shares has to sign off on the shareholders agreement, or they do not get their shares. So what does a shareholders agreement do? I mean, it could be 5 pages or 100 pages, but in general, it does a couple of things. It does the standard, the standard stuff of naming the directors and the officers and their titles in the corporation, who's on the board of directors, when there will be board meetings, when there'll be shareholder meetings, what the corporation is required to report to shareholders. Okay, so that all stuff is sort of laid out in, let's call it corporate governance. But then pretty much what the whole, it'll dictate insurance and things that are important to shareholders. It will dictate what the board of directors is allowed to do without shareholder approval. Like, for example, maybe the board's not allowed to sell the whole business to somebody else without going to shareholders for prior approval. It might say that the board can't borrow money over X without going to shareholders, or spend over X in a single transaction without going to shareholders. And so it does that. But then the whole rest of the document really is about share transfers. It's about exactly what we're talking about here, is getting rid of partners. And so what a shareholders agreement would typically say, like so many legal agreements, is that you can't do that at all. You can't sell your shares, period, unless you sell those shares in accordance with this agreement. So basically what it says is you can't do it at all, but then it gives you some opportunities to do it, some exemptions to that rule that you're not allowed to sell your shares. And it really breaks down into 2 types of transactions. One would be a third-party sale. So let's say A and B are 50 each and 50% of the company each, and A wants to sell their shares to a competitor, to a strategic purchaser in a third-party sale, and B isn't necessarily sure that they want to, or it never occurred to them. And so the first thing that a shareholder agreement normally does, it has what's called a first right of refusal. So A comes and says, hey, I've got a legitimate offer. I can go sell this to Elon Musk and I can get, X dollars for my 50% shares in this company. And then normally the first thing a shareholder agreement would do, and you have to have the clauses in there. Somebody has to draft this. So they're not all the same. But typically what you might find is that B would have what's called a first right of refusal, which is, okay, you have a bona fide offer. You can sell your shares to Elon Musk. And so I have a right now to buy those shares from you instead, and for the same price on the same deal. And so you can't sell to this other person, Elon Musk. You have to sell to me, shareholder B, and I have 30 days, 45 days to come up with the cash to buy you out if I notify you that I'm going to exercise my first right of refusal. So that's sort of the first thing that happens, is you want to sell to Elon Musk, in my example, to a strategic purchaser. but you're forced to go through this first right of refusal. Now, let's say your partner B, shareholder B, doesn't have the money, or they don't want to buy the other 50% because they can't run the business by themselves. Well, now you get into tag-alongs and drag-alongs. Those are fun, right? Tag-along rights and drag-along rights. So a tag-along is, well, let's do a drag-along first. A drag-along is shareholder A, who is now committed to sell his 50% to Elon Musk. Well, Elon Musk doesn't want half the company. He wants the whole company. So now, because shareholder B passed on the first right of refusal, shareholder A can now implement the drag-along clause, which means, cool, I get to sell my shares and I can now force you to sell your shares. I can drag you along in my transaction. And therefore, the purchaser, Elon Musk in this case, gets 100% of the company pursuant to the drag-along. Okay, so it could do that. Or you could have the tag-along clause, and the tag-along is Elon does want 50% of the company, and shareholder A has 50% of the company, and B says, wait a minute, I didn't agree to be partners with that person. I wanted to be partners with you, shareholder A, and I don't want to be orphaned here with 50% of this company with a partner that I didn't sign up for. So I'm going to implement this clause, execute on this clause called a tag-along, and I'm going to say that you can't sell your shares unless that guy buys my shares as well. Okay? So you've got first right of refusal, drag-along, tag-along would be typical clauses that you might see governing who can sell a share and exit a shareholder, their shares in a private company relative to getting rid of a partner. Now, let's say none of that's happening. Let's say there is no third-party sale, but you want to get rid of your partner and you want to buy them out and you want to do that contractually. Well, that is often in a shareholder agreement as well, and it's done through what they call a shotgun clause. And the shotgun is, you're holding the gun at them and they're holding the gun at you, and who's going to pull the trigger. It's all very dramatic. But the idea here is that shareholder A wants to get rid of shareholder B, and so shareholder A serves notice under the shotgun provisions of the shareholder agreement and says, all right, I will buy out your 50% for, make up a number, $1 million. Okay. I'm going to give you cash in 30 days and I will buy out your 50% of the company. And now shareholder B, having received that offer pursuant to the shareholder agreement, has the immediate right to say, no, I want to exercise my right to buy you out for $1 million. So whatever number shareholder A offers to shareholder B, the risk to shareholder A is that shareholder B can do the same thing back to them and shareholder B wins, right? And so this is some legal tricky way come up an idea that's been in common law forever. And again, this is in most jurisdictions, by the way, in the West anyways. I'm sure there's lots of jurisdictions where people are listening where this doesn't work the same. All right. And again, I'm not a lawyer. I'm specifically not your lawyer or any lawyer, but but the idea of the shotgun here is it forces if shareholder A says, yeah, I know these shares are worth $1 million, but my offer to you, shareholder B, is $10. Well, then shareholder B says, cool, here's your $10. I own your shares now. So it's a way to force shareholder A, theoretically, on paper, to come up with a good price, a fair price, right? A price where shareholder A would be either happy to buy or to sell, one or the other, right? And so that's, the initiator of the shotgun provisions is kind of on the hot seat, theoretically, on paper, to come up with a fair price. And the problem with the shotgun agreement, of course, is it only works if you have cash, or you can finance this thing in like 30 days or 45 days, which would be the typical turnaround times provisions of a shareholder agreement. And so if you're the fellow with cash, or the gal with cash, and your partner doesn't have any cash, then you can just in effect bully them by putting your initiating offer would have nothing to do with the value of the company and everything to do with how much money you think your partner has, right? So if you're entering the shareholders agreement and there's a shotgun, just beware that if you're the one without the money, you're in a particularly bad position. But in summary, in answer to your question, if you don't have a shareholders agreement, there's kind of nothing you can do other than persuasion, negotiation, threats, which are probably empty but are a nuisance, right? And that's about it. And if you have more details that you'd like me to address, if I'm off the mark because I don't know the context of your question, there you go. Feel free to send those through. I had another question about, I think it was a couple of weeks ago, and I hadn't got to it yet, about the state of the cannabis industry in Canada. As you know, Canada was one of the global leaders in cannabis legalization and the public market valuations and access to capital. The whole globe was coming to Toronto specifically to raise money, the whole globe in the cannabis business, to raise money. And, what's going on with this, with this disaster in the cannabis business. And I found it, I wasn't going to address this issue, but I'm off to a conference in Vegas this week, speaking at a hemp-derived CBD wholesale conference. And so it's related to this. And I thought I would bring myself back up to speed this weekend. And so there was an article in the Globe and Mail over the weekend, long weekend in Canada. The Globe and Mail is, for my U.S. audience, is the Wall Street Journal of cannabis. And this was just sort of a soft, fluffy article that didn't really say a lot, but it reminded me of things. And it referred to Aurora Cannabis, which, if you listen to Martinis with Scott, back in the day, I was covering a lot of cannabis stocks. Look, I am not a financial advisor. I'm not a professional investor. You should not be listening to me for investment advice on anything, but I'm a bit of an expert in evaluating management teams and the directions of companies, the momentum, whether that be negative or positive, obviously. And I'm happy to tell you what I'm thinking, and you can just take it or leave it for whatever you wish. And so what I told you I was doing, and I had just as a reminder on the Martinis with Scott channel, that I had come off a very successful summer shorting CanTrust, which was a Canadian cannabis company traded on the TSX, where there was a fraud, a very entertaining fraud. They had hung false walls in their greenhouse, and they were growing illegal plants behind those walls to increase their production. And then they were caught or ratted out to Health Canada. And in the midst of all that, the insiders were all selling their shares and getting out at a high price, at high valuations, and not disclosing things to the market. So it was just it was a textbook. If you had opened a textbook on what not to do in securities fraud, I don't know if they were charged for fraud, by the way. I'm not making that a specific allegation. But if you were to open a textbook about securities fraud and how not to do things, CanTrust was a good example of that. And so I talked a lot about, after that, Aurora Cannabis, one of the larger Canadian LPs, licensed producers, back then. And, Aurora Cannabis, I'm just looking at a chart right now, had traded at, I don't know what high it would be. There's $161, $164. So those are some of the peaks. And I was ignoring it for a long time until it went on a huge drop around mid-19 to 2020. And I was suggesting that I was going to, at around $16, as I recall, I was going to start shorting it, which I did. I had come out of my CanTrust trades, and I was going to start shorting Aurora Cannabis. And I don't even remember why, other than just general incompetence, it seemed to me, of the management team it wasn't based on financial fundamentals and valuations. It was more based on just ridiculous communications and skill sets. It seemed to me in Aurora in particular. And so around 16, 18, I was shorting, and today I haven't paid attention to it in a while because I've exited all that. But today they're at $3.73. So I feel like I called that one well. Now, I could have picked, in retrospect, any Canadian LP, and I would have had similar success, but I was certainly hot on Aurora at the time. And so this article in the Globe and Mail is talking about Aurora Cannabis shutting down its flagship growing facility in Medicine Hat, Alberta, which ironically is just a few hours down the road from where my house is that I am in right now. The greenhouse Aurora Sun was projected to be one of the largest in the world, the size of 21 football fields with a capacity of 230,000 kilograms of cannabis in a year. Would have created close to 700 jobs in Medicine Hat, which is a town of 60,000 people. They announced Aurora, I guess, just before the weekend, had a quarterly call, which I was not on, but they announced, it seemed to be the driver of this article. Company disclosed that it was in the middle of a pending sale of Aurora Sun that would yield it approximately $47 million. So they were going to sell this greenhouse in effect and get $47 million out of it. Who would pay for that? Who needs that capacity right now? I mean, maybe it's the real estate. No, it can't be the real estate in Medicine Hat. You know, when you sell a greenhouse, there's a lot of assets. And there's a functioning facility. And it's set up for security and monitoring, which is all part of the regulation if you're going to grow cannabis in Canada. Anyways, I don't know. I don't know who would pay $47 million. That just seems crazy to me in this market, in this industry. So they sold it for $47 million. I wonder if that's cash. I bet you it's stock. I bet you it's the old relative valuation thing. Have I ever told you about the little boy trying to sell his dog? Did I ever tell you about that in relative valuation? So, you know, a businesswoman leaves the house in the morning, and she passes a little boy on the street, and he's got a puppy dog and a sign up for sale. And she says, "Hey, little boy, you're going to sell your dog? You're going to sell that cute little puppy dog?" And the kid says, "Yeah, I sure am, ma'am. I'm going to sell this puppy dog. He's worth $1 million." And the woman laughed and said, "You know, you're not going to get $1 million for your puppy dog, but I love your enthusiasm, but you're not going to get $1 million for your puppy dog." And the little boy says, "Yes, I will." And on the way home, the woman's walking home from work, and she passes the same little boy, and he's playing with two kittens. Dog's gone, playing with two kittens. She said, "What happened to your dog?" He says, "I sold them. I sold them for $1 million. She said, "You did not." He said, "I did so. I have these two kittens, and they're worth $500,000 each." Relative valuations. I should go look this up for fun, but if they got $47 million for the facility, I wonder if it's in stock. I wonder if it's in somebody else's overpriced, illiquid stock, and that's why that is. Anyways, $47 million was the sale. $250 million is what they put into it, so they're taking a significant loss. And that facility was never opened. They never got around to being, actually, that's not true, but never fully operational, it says. What else we have here? Amid sluggish earnings, stagnant demand, and the overall market saturation, some of the largest cannabis companies in Canada have spent much of the past 2 years downsizing and consolidating their operations. That is going to continue. That is the state of the Canadian LP, cannabis LPs. What else do we have here? Alongside disclosing the potential sale of its Sun greenhouse, Aurora announced it was closing another flagship facility, Aurora Sky in Edmonton. That would affect 13% of the company's workforce. So they're just wrapping up basically here. Indeed, the four largest cannabis companies, Canopy, Aurora, Tilray, which merged with Aphria, and Hexo, have shed thousands of jobs since the hiring peak in 2019, mainly because they are now closing greenhouses etc. So that's a just general overview of the industry. For those that were asking, because I used to do a lot of shows on cannabis and I don't anymore because I ran out of liquidity on the shorts. And so I really stopped paying attention to it. And of course I love the space still, but it needs to shake out, and you need to be careful where your opportunities are. And so it just reminded me of how did this happen? How did this Canadian industry fall apart? And everybody's pointing fingers at, different univariate analysis, as people so often do. And in truth, everything complicated is for multiple reasons. It's not just for one reason, but some of those reasons are that that there's no world market. That would be one. And so all of these large Canadian LPs were raising a bunch of money to grow a bunch of cannabis. And Canada is a country of 35 million people. And if you were to look at your target market, the people that are legal to buy cannabis, it would be a lot less than 35 million. And so you're not growing all this cannabis for the domestic market. There's still not very many people here. And so what was the idea? Well, the idea was that you could export it. You could export it to Germany, to South America, to the U.S. when the U.S. legalizes. And the truth of the cannabis industry is that there is no global market. It's a series of differently regulated local markets. And there's no real, it's not that you can't export, it's not that you can't do international trade, but it's really burdensome and it's not a significant market. And so this first to volume to drive down the per unit cost of the cannabis has just been a failure because the market hasn't been there at that scale. And to add to the market not being there is the regulated genetics, the strains of the plant that you were allowed to sell in Canada were highly regulated, and they were crap. I'm not a user. Even recreationally, I don't really know the plant very well. But I know the business a little bit. And so the genetics are not very good. And I think that's changed. I think the genetics are a lot better now. But back when it all started, they were just losing. The licensed producers were losing to the black market. And that's starting to change, as I said, because the genetics are getting way better. But if you could just go buy cheaper from your regular dealer, in the apartment below you or wherever this person is, and get the stuff that you like, why would you bother going to a store to get crap that you're paying a lot more for, right? That was sort of the market's view of this. And so the industry is in chaos, and it just reminds me of when things were becoming legalized in Canada, and these companies were just raising so much money. And if you had a decent PowerPoint, you were going to get $100 million or $500 million at a really great valuation. And the valuation metric was what they called, when I was paying attention back then, funded capacity. Funded capacity. So what does that mean? Well, it literally meant, I've got a greenhouse and it's so many square feet. So for example, I was working with a company which was literally a neighbor to Afria back then in Ontario. And off the top of my head, it's been a number of years ago now, but it was 680,000 square feet. When you stood in the greenhouse, you couldn't see the end of it. It was crazy. And so you could be valued on the size of your greenhouse, which of course would back into how many plants you're going to have. And if you're going to get 5 grows a year, and then you could just assume that you're going to sell all that stuff at $10 or whatever. And, that's how you built your cash flows, which just spit out crazy valuations. And then as the market became more hot, they moved into funded capacity, which was, I've got 680,000 square feet, but I'm going to build to 1.2 million, and I have access to the cash to do it. So my capacity would be 1.2 million, even though it doesn't exist. And the funded is I can get the cash to do it. And the market said, cool, we will value you based on your hypothetical plan, right? And I used to wander around and talk to fund managers and investment bankers, and no one wanted to listen to me, of course, because they're all making crap loads of money. But I said, it's like Molson Coors being valued on how many acres of, grains or hops or whatever they have growing. It just makes no sense. It makes no sense. At the end of the day, I thought this industry was going to shake out to move from the farming, from the growing, to the manufacturing, which would be the extraction, to brands. And brands are where the value is going to be. And I think a large part of what you're seeing in this industry is a shakeout where the value in the value in the growing side of this has just gone away. And if you talk to any grower, I think they're going to tell you the same thing. So I'm president of Globex Extraction, which is a hemp-derived CBD extraction facility in Loveland, Colorado. And our models, this was not my business. I took it over for a dear friend who passed away, and I'm an executor, and I took over this business. And, the models were built on a what they call a tolling relationship, which means farmer's going to have a bunch of hemp, and they're going to pay us a fee, and we're going to extract for them, give them their product, collect our cash. And by the time the facility was built, no farmers had any money because they're all getting killed because there's no, there's no value add in the farming, and the regulation and crops turning hot, so they're not knowing what they're doing. Like, there was all sorts of problems on the farming side of this, but there was no market for this business. And so then what you do is you go, okay, well, I'll just process your stuff for free. I'll process your biomass for free, and we're going to create whatever, a tea-free distillate out of that, and then we'll split it, 50-50, 60-40, whatever, and you end up in the product business when you didn't want to be in the product business. And now what we're doing with that company is we're creating our own CBD brands. We've been doing market research, which has been going really well. And I am speaking at a CBD wholesale hemp-derived conference next week in Vegas. So there you go. There's cool. That's cool. That's my view of the cannabis industry. What else do I have for you here? I was noting, we talk about stock valuations and how things are valued, how markets work. And I was laughing to myself over the weekend here. I just saw a headline and looked briefly at I think it was a Wall Street Journal article on the Russian ruble. Now, I don't want to talk about what's going on in Europe right now because the video then gets banned by the social media companies. So I'm trying not to talk about that and my concerns about what is going on in world affairs. But, with sanctions put by the West on the ruble, the idea here was that the Russian currency would collapse, and that would cause great economic hardship to Russia. And the truth of the matter is that the ruble, since the beginning of this whole mess, has skyrocketed. It's at its all-time peak. And again, don't hold me to the details of this because I didn't dive too much into the article, but it is a fact. It is a fact that the ruble's done very, very well on paper throughout this chaos. And I've tried to talk to you on the Winning Momentum podcast before about, when we talked about inflation, for example, to think about almost everything. Just think about supply and demand as just the driver for anything when it comes to price and valuation. And it would be the same thinking for this issue, right? And in this case, if you're in Russia's shoes, it's supply and demand with third parties, someone outside your country, because they're the ones valuing the ruble in the sense that they will pay X of whatever, US dollar, a pound, some other currency for that ruble. And so think supply and demand. And what they did in Russia is they put currency restrictions on the ruble. And so what does that mean? Again, supply and demand. Well, they restricted they restricted, if you're a Russian citizen and you have some rubles, they restricted what you could do with that. You couldn't buy goods outside of Russia with your rubles anymore. In a sense, and I don't mean all goods. I don't have the details on the exact of that, but they restricted what you could do outside of Russia with your rubles. Well, why? Because that lessens the supply to the outside countries, right? So let's just pick on one country so I can express this easier. Let's just say it's Russia and the U.S. And so if you're an American citizen and you want to sell your goods into Russia, which I know is prohibited, but if you want to do, just hypothetically speaking in this example, well, you couldn't get rubles for that, because if you did, that would be a greater supply of rubles in the U.S., right? And Russia didn't want that. So they were restricting their citizens from using rubles to buy things from outside the country. So that's the supply side. You want to lessen the supply if you want the price to go up, and you want to increase demand if you want the price to go up. So how did they do that? Well, first of all, they demanded that commodity exports, oil in particular, and I think some other mining products, metals, etc., they demanded that instead of being paid in U.S. currency, which they were before, they have to be paid in rubles. So now if you're, in the U.S. or some country outside of Russia and you want to buy Russian oil, all of a sudden you have to pay in rubles, which means you have to get the rubles, which means there's now a demand for the rubles, okay? And the second thing they did is they said that Russian exporters who have a bunch of foreign currency, say it's all in U.S. dollars, they had to convert all of that to rubles, creating more of a demand. And so you've got less supply artificially, you have more demand artificially, and what does both that do? Well, it drives up the price of the underlying asset. In this case, we're talking about rubles. So always think about supply and demand. Don't think that the rules and the sanctions and all this sort of stuff are not working. This is an artificial pricing and valuation of that currency so that their domestic world doesn't fall apart. But it'll come to an end because you can't sustain that forever. I'm reminded when I was writing this or just making myself some notes a long time ago on Bay Street, and I was talking to a stock promoter. Is that the right word? He was a licensed stock broker, which is a business I've never been in. He's a licensed stockbroker and a stock promoter, and he'd been sanctioned pretty heavily by the regulators in the day for some aggressive and shoddy wealth management practices, in a sense. And his side of the story, which you should not believe, by the way, I don't believe it, but just for entertainment's sake and to hammer home this point, is that his side of the story was that he had some, he was one of Canada's top stockbrokers, and he had this woman come in and she had some number, let's say $100,000 in liquid wealth to invest. And so he got the money into his account at the brokerage firm, and within 2 years had turned it into $3 million. Okay. And maybe it was even left. Maybe it was 50,000. It was not a lot of money in the grand scheme of things, and had turned it into, say, $3 million, a significant number in a very, very short period of time, 18 to 24 months, as I recall. And then what he did, because now she has $3 million of wealth, and this was not a wealthy woman, and this is back in the 90s probably, so $3 million was real money then. And so he said to this woman, what you need to do now is you need to get some proper financial planning. And he recommended her off to a financial planner who was not a broker, who was not trying to sell her anything, but someone to just work fee for service to get some proper financial advice. So off she went to this so-called friend of the stockbroker who is evil, and this financial planner looked at this portfolio and said, holy crap, you've got a limited amount of wealth, whatever, $4 million, and $3 million of it is in these stocks with these stockbrokers, and none of those stocks are liquid, right? What is going on? What kind of financial planning is this? And so he picked up the phone and reported the stockbroker to the regulators for not knowing his client, making risky investments, this and that, to which the stockbroker couldn't understand what he'd done wrong. What he said to me is, of course they're illiquid. Of course it's illiquid. How do you think they got to be $3 million? He's a terrible person. But it is the illiquid nature. It is the restrictions. And illiquid in the stock market means that, there's really no buyers and sellers. So a little bit of activity really drives up the price, which is how stock promotion works. And so he had created this false number through being in illiquid stocks as opposed to bank stocks or, something that's really liquid and doesn't move very much. And so he created this on paper and then got himself basically booted out of the industry at the end of the day for that. Here's the lesson. Here's the tie-in between the Ruble story and the stockbroker story is that, if you're in that world, if you're trying to buy things that are unusual, that are off market, that are alternative investments, the value of that asset that you're buying is not distinct, separated. I guess separate is the word for my work that I'm looking for. The value of that asset cannot be separated from its liquidity. It may be the liquidity that's driving the price. Often it's the liquidity driving the price. And if something is really liquid, the price would be different. And when something that's illiquid becomes liquid, it's going to come to an end. Okay. That's what looking at the Russian ruble reminded me of. Good listen for those of you in my audience that like to trade and invest. And I'm not giving you advice on that at all, but something to think about. Always pay attention to your liquidity. And it was liquidity that got me not the returns that I was looking for on the short of CanTrust and Aurora. I did really well on those, by the way. I told everybody that summer that my trading philosophy was short weed and long shrooms. Worked out pretty well for a while, but then the shroom market fell apart. I got caught with my pants down on that one. But I'm not here to give you trading advice, but just think about, I'm a business valuator by trade. Liquidity is an important part of valuation. Never forget that. And don't be fooled when you look at something like the ruble or a penny stock or an off-market investment. Liquidity often drives up pricing. Okay. And with that, we're 53 minutes in. I'm not going to do my 15, 20-minute speech for you because that's just too long. I'm going to go back to packing for my trip to Vegas in the morning. This has been the Winning Momentum podcast with your host. That's me, Scott Sinclair. Hey, check out thescottsinclair.com, thescottsinclair.com. That's my new personal website. Go on there. All of my content is being posted there now. You can subscribe there. You can get notifications. It's coming together nicely. Please do me a favor. Go check that out. And you can watch these shows through that website. Or, of course, as always, you can go on YouTube. You can subscribe where the podcast version of this is on Apple, Spotify, everywhere, Google Play, everywhere, Amazon, everywhere that you listen to your audio podcasts. Thank you for listening. I'm Scott Sinclair. This has been the Winning Momentum podcast, and we will see you next week.